Metropole Television, you're most definitely watching Business Talk to Us 2146. That's your SMS line at Metropole TVKE. That is your social media platform. And I am at Charles_Kiag on Twitter. Let's get speaking there for this morning. We are joined by George Bodo, who's going to really paint for us a picture of the banking sector within the COVID-19 pandemic. But we're coming from a research that was conducted by KDA that indicates that 72% of banks are likely to remain cautious, and that we are likely to see NPLs increase to 14% from the current 12.4%. They're also talking about 94% of banks expecting a significant slowed economic growth, and they're also expecting that 87% of applicants, therefore, that they spoke to will seek restructuring of tenure and interest reliefs. Also talking about 67% of the respondents anticipate that the popular tenure extension will be 1 year. And then according to the Central Bank of Kenya data, now loans worth about 82 billion shillings have already been restructured. That's what we're coming from this morning. And George, my question to you this morning is that would the banking sector be ever ready for this sort of response or effect that they're feeling now because of the COVID-19 pandemic?
Charles, I mean, it's a very unprecedented event. I would imagine nobody was, even the largest economies in the world, were not ready for something like this. So you can imagine the banking sector. So essentially, they were not ready for this. Nobody was ready for this.
To see exactly what is happening. If you look at these non-performing loans that we've seen this morning, was that expected? And are you surprised that now we're talking about 14% from the current 12.4 market rate? Do you expect it to continue growing, or it's going to be at 14%? That's we wait to see what happens next.
Yes, we do expect the liquidity levels to keep rising. And this is because, Elijah, as you know, the pandemic has disrupted the global economy. It has disrupted the global supply chains. It has decimated businesses. And you talk about Kenya, for instance, which is an economy driven largely by small and medium enterprises. And you have you have a significant number of banks, actually talking about over 20 banks that focus on SME sector. Now, a good portion of them, right? I mean, a good portion of SMEs have had to close down businesses, and you can see the government ordered restaurants and business and entertainment joints largely to close down. Apart from that, the curfew has caused a number of businesses to reduce capacity and essentially cut down on production. Apart from that, the large corporates operating in the aviation and basically hospitality and tourism sector have also had to close down businesses. I mean, you had big brands shutting down the shops. And you talk about, for instance, Kenya Airways, passenger business is down. Now they're trying to operate the cargo side. Now, when you look at all these things, and the worst thing is that there hasn't been any bailout mechanism from the national government towards resuscitating these businesses. So now, you essentially, with all these factors coming in, converging, you really expect a good portion of banks' loan books not to be performing. And the fact that the problem is that when you look at the trajectory, even before the COVID, banks had non-performing loans issue. And now you have COVID in, which is likely to exist, or rather has already exacerbated the issue. So we expect NPLs to rise. I mean, I've seen quarters talking about 14%. I mean, from where I see it, I think this thing in reality could go as high as 20%.
Which percentage would we look at in the market, George Bodo, this morning and say, well, that is ice cracking? Because if you're talking about 14%, that will rebound. But which percentage are we going to get to, George, and you will say, ice cracking in the banking sector?
You start talking about 18-20% now. That's very significant levels. Now that triggers what you're talking about, some level of hair splitting reaction from the market, and also at that level, and you look at the whole band of the banking sector, who can withstand 20% level. Obviously, the tier one banks can withstand 20%. Well, the smaller tier two, tier three banks, obviously the figure will be much higher because of the level of exposure they have, and the lack of insulation that the tier one banks have. And the tier two, tier three banks will be more vulnerable at that level.
Listening to you this morning will point to the dividend season we just concluded the other day, and we did see that in the NSE 20, we did see that the banks, most of them, they did cancel their dividend season. In fact, most of them got into, other than NCBA, which actually took a different angle in terms of the way they were looking at this. What do you say, therefore, because of the unpredictability in the market right now, in the way the banking sector is going to perform in 2020, that it must have been a misjudgment from these quarters, because it is now more certain than ever that nobody knows exactly what's going to happen in the banking sector?
Yes, that's true, Charles. That's very true. I mean, when in situations like COVID, the risk that you're running is that there's high level of uncertainty. And I've just told you that at certain, when you have NPLs crossing certain levels, the more smaller banks are more vulnerable, and the vulnerability is transmitted through their balance sheet. You need to have more capital buffers to withstand any incremental aspect of the non-performance. So when you have dividends, when you're paying out dividends in statements like this, then you are actually reducing the insulation you have for your balance sheet. The whole purpose of not paying dividends is to build more cash reserves, to fortify your balance sheet so that you can withstand some of these things. Now, I think this is what an entity like NCBA saw. I think initially they had actually gone ahead and the board and recommended a dividend. But I think with the hindsight, they had a sit down and they said, wait a minute, guys, this thing, we might need to fortify our balance sheet. Let's recall that dividend. Instead, let's give our shareholders a bonus share. Now, if you look at, I think I don't expect, I thought I would expect the regulator to say, I mean, the Central Bank of Kenya, to actually come in and wait on the issue of dividends, because I think banks need to strengthen their balance sheet right now specifically, and they strengthen their balance sheet by not paying. Part of it is not paying dividend. Instead, you can give your shareholders bonus shares. So I think in 20, well, a number of them had already paid out dividends, but I think there's also an issue of shareholder pressure. I think they had an issue of shareholder pressure. Sometimes shareholders, especially in boards where you have one majority shareholder, which is very strong. Sometimes shareholder pressure, they yield to shareholder pressure. The management yield to shareholder pressure and issues that pays the dividend. But I think that 2021 and through 2022, I should really see no dividend payouts from the banking sector until this thing and they come back, some normalcy returns to their balance sheets.
All right, so I'm going to talk to you about this now in terms of the way you expect the banking sector, therefore, to perform in 2020. Now, every economic package, or so, I would just say in quotes, as we've really seen it go through the banks. We've seen the CBK really trying to introduce even these funds. It's pretty much saying, I'm going to give it to the banks. Yes, I reduced the CBR, so the banks will be able to give you this money. Would you say that it's keenly trying to caution the banks as well, saying, well, if I'm going to look for money, I have to give it to you so that you can actually make something out of it? And is that enough, therefore, to bolster the performance of the banking sector in 2020?
Well, good question. The whole purpose of that, what we call the monetary policy easing, which you've seen at the monetary policy meeting, policy committee meeting in March, they came up with draft proposals. One of them was to cut the cash reserve ratio, which is released, according to the central bank, 35 billion shillings to the banking sector. And also they cut the signal, the policy signal to CBR. They cut it by 20, I think it was 50 basis points in the subsequent meeting in April. The whole point of this is to open up what we call a liquidity window for banks. So that some banks might have a liquidity stress, they might have difficulty in realizing some of their meeting some of their obligations, for the fact that they cannot liquidate some of their assets in terms of distress. So then the central bank becomes a lender of the last resort, which is exactly what they've done. They're saying we are cutting your reserve requirements, which is essentially reserve requirements, the amount of money that banks keep with the central bank to guarantee payments. So when you cut it, you release a certain amount of liquidity back to the banking sector. However, they don't do this to support banking sector profitability. Rather, they do it because they want the banks to continue that lending machine to continue grinding. They don't want it to come to a stop. The only challenge is that that lending machine may not continue grinding because of two reasons. One is that obviously credit risks are elevated in the economy right now. I mean, banks are very careful who they're lending to right now because obviously of what's going on. And the second issue is that um, um, the, the banking sector are also very, very, very careful. They want to protect the capital. They don't want the capital to go away. So a combination of these factors will also see that grinding machine grind to a halt, so to speak. So the central bank, on the other hand, they're trying to tell banks, look, don't stop that grinding machine. We're going to help you. We're going to avail some liquidity mechanisms for you to continue lending, because they're more concerned about the private sector side of the economy not having access to credit, because the government wants production to continue. The only challenge is that supply and demand has been decimated at the moment. So it's not essentially but in terms of profitability, which you're talking about, profitability will take a dip actually. Talking about profitability, let's go back to the issue of NPLs. You know that banks right now are operating on IFRS 9, which essentially transitioned banks' loan impairment mechanism from the incurred loss model to expected loss model. Expected loss model means that banks have to model, they have to look forward and say, okay, fine, looking at our loan book and the prevailing economic conditions, how do we expect our borrowers, customers to perform? Obviously, they use what you call the probability of default. They call it PD. Now, when you sit today, in fact, going back to quarter one, when banks projected the economic performance for the year, it's not looking good, right? Different quarters have projected different growth rates. I mean, I see negative growth rates, actually, real GDP growth rates in 2020. Now, that should translate into banks increasing their impairment charges on their customers, because then the probability of default is very high in 2020 through 2021. So I expect profitability to really, really go down. If not, some banks are supposed to report losses in 2020, by the way, if they stick to that PD rule.
The only way that we're going to look at whether the banking sector has learned from any lesson, Bodo, this morning, is we go back to the 2008 financial crisis when every sector was crashing down. And after the 2008 financial crisis, well, it was, have you learned a lesson? So do you think, therefore, the way in which we have positioned our banks, I want you to talk to me about tier one banks. Do you think that we have high equity levels in our capitals, which can take us for 1 year, 2 years down the line? Because from what you're telling me is that in terms of talking about profitability of the banks and good business in this sector, we have to talk about 2021 upwards as opposed to now in 2020.
I think the much of the banking sector, well, you ask a very interesting question. Banks never learn lesson. By the way, to answer your question, they never learn. They have this beautiful way of getting themselves out of every situation. One of the things that happened after the 2008 financial crisis was the puzzle for regulators was how easy it was for banks' balance sheets to collapse. It was so easy, and the regulators were puzzled. They sat back and said, look, I mean, the committee, which is called the Basel Committee of Banking Solutions, they sat down and said, okay, how should we avoid such a scenario again? Then they came up with what we call capital conservation buffers. So essentially, this is some sort of a rainy day fund, like if you have a crisis, then you have some 3 levels of defense, you have the primary level, you have the secondary level, you have the tertiary level of defense. So they build these capital buffers, and that's one. Two is also they said banks should not look at loan losses from an incurred model. They should be able to project these things on a forward-looking basis, which is why we're in IFRS 9 scenario. The second thing also is that banks are supposed to have a capital conservation buffer, some kind of a third line of defense. Well, they built it. The implementation has been very different across different jurisdictions. In Kenya, we chose to take what we call a capital conservation buffer, which was pegged at 2.5% of the risk-weighted asset. I don't think the implementation has been very robust today, that the extent that if banks were to face crisis, they will withstand it. They will not be able to withstand it. The second issue was the regulator said, let's change how banks measure liquidity. By the way, let's introduce what we call a liquidity coverage ratio, where banks are supposed to cover their liabilities that they forced due on a 100% basis. We have not implemented that in Kenya, for instance. We are not on Basel III. By the way, we are still operating on very old prudential models. We need to move to Basel III of liquidity coverage. So today, I don't think banks have enough liquidity coverage. If this thing was to persist on an extreme scenario, I think banks will not be able to withstand. So to answer your question, we have not learned the lesson of 2008, by the way.
Which therefore begs the last question this morning, George Bodo. If you haven't learned the lessons, therefore, you'd expect that we have a lot of insulatory regulations, therefore, that we expect to be pushed to the sector. Do you expect more? And where are they going to start from?
Yeah, I expect some insulation, actually. First of all, one of them is liquidity. The central bank said, okay, fine, we'll cut your CRR. Okay, now we're releasing some liquidity for you. That's one form of insulation. Another form of insulation is to say, okay, fine, because IFRS, the current accounting regime, which IFRS is very strict. They have 3 buckets. If this is performing like this, put them in bucket 1. If it's not performing, put them. If they're performing and if they're performing but they're looking like in the next 3 months they're not likely to perform, put them in another bucket. It's called the second bucket 2. If they're not performing totally, put them in bucket 3. So what's going to happen is, as part of regulatory insulation, which I've seen across some jurisdiction, is central banks are sterilizing those buckets. And by sterilizing, I mean nobody's moving from bucket 1 to bucket 2. Nobody's moving. And that is not really good. Well, I saw the IMF, is in their latest staff report on Kenya, they said they should not do that. They should actually let that mobility. But part of the insulation is you sterilize those buckets. You say, okay, fine, clients are not performing. We are asking you to give moratorium on loan repayments for X amount of, actually right now I think it's between 3 months and 6 months. So we are asking you to restructure those loans, issue repayment moratoriums. Now, but at the back of it, don't also move them, because when you don't receive payments for 3 to 6 months, they're supposed to move from good customers to bad customers. Don't move them. They not pay for 6 months, but let them still be good customers. Now, that does not apply to accounting. So that's what you call, that's the kind of insulation that they're being given. Because then when they move, it has capital implications, right? They have to recapitalize. They have to resend to the balance sheet, because then shareholders have to take the hit. So shareholders are being insulated here, Charles.
And there was a lot of questions I wanted to talk to you about, and most notably, therefore, is the way in which the IMF really views the way in which we run our economy in relation, therefore, to the banking sector. Guess what? That's going to be our next conversation, George. I'm so sorry we've run out of time this morning.
No problem, Charles.
Lovely. All right, we take this break. Actually, the last one this morning, and that's exactly what we have for you for Business AM. Guess what? Take George Bodo back to the time that he came into the studio this morning, all the way on YouTube at Metropole TVKE, or write to us this morning, 2146. My name is Simba Elijah Charles Kiage. I'll be with you at 10 and 11 for Metropole News. But for now, the Business AM team is saying good morning and goodbye.